Thanks, Gurpreet, for your interesting views. I guess if I was to merge a couple of your themes into what I think is a great opportunity is the advancement of technology on the one side and the larger availability of data on the other, especially about companies' operations and sustainability. And I think no one's better at discussing that than our next speaker, Wilma de Groot, who's head of quant equity at Robeco. She's going to tell us how to take advantage of that opportunity and eventually build equity portfolios that have them all actually a higher sustainability, a better fundamentals, and lower valuations. So Wilma, over to you.
Yeah, thank you so much. And I'm very delighted to be here in this nice location. I also enjoyed the dinner yesterday in St. Paul's Cathedral very much. And I think talking in investment terms, it will be a difficult one to outperform for the next couple of years. So that's also a challenge, right? I'm also very happy to present today on the insights on how to build a sustainable equity portfolio with the aim also to deliver higher returns than the market based on proven research. And let's first talk about the why. Why would we want to invest in sustainable portfolios? Well, obviously, we are currently in a highly changing environment with many initiatives towards a better world. And some of these initiatives, you're probably well aware of them. We have the Paris COP21 agreement, where agreements have been made on limitations on global warming, not more than 2 degrees Celsius. There are also net zero initiatives to reduce carbon emissions, even up to net zero. We have the Sustainable Development Goals of the United Nations, aiming towards a better, sustainable future, and addressing challenges like inequality, poverty, climate changes. And we also notice, we observe actually that asset managers and also asset owners, they are following up on this by not only focusing on wealth, but also on well-being. And this also increases the demand for sustainable strategies. And what you can see on this slide is the growth actually that we've seen in the past 5 years of ETFs that are tracking sustainable indices. And you can see that that growth has been tremendous, currently over $200 billion. And of course, we expect, given the current environment, that this trend will continue. And these ETFs that are tracking indices, basically we call this a sustainable passive approach, where a sustainable index is being passively tracked. We see that this has quite some attractive features. I would like to mention a couple of them. First of all, tracking a sustainable index offers access to a market premium and also at the same time to sustainability. Secondly, for an investor, it delivers predictable return and risk characteristics and also predictive holdings, right? Because the same index is being tracked, so you expect similar type of returns and risk profiles as that underlying index. Thirdly, we also see nowadays that there's quite some offering available in the sustainable indices. So there's quite some choice for investors to make into how to actually integrate sustainability. And often, not always, it's relatively low on fees. That might also raise the question whether there aren't any disadvantages of that approach. And yes, we think there are also some concerns. It might also be good to address those. First of all, we see that often these sustainable indices, they focus on one dimension, one sustainability dimension. So it's often either exclusions, or it's ESG integration, or it's carbon reduction, but you don't often see a combination of these different dimensions. A second element, which I personally think is an important one, is how voting and engagement is actually integrated. Of course, also in a passive approach, voting and engagement can be done by the passive manager that is tracking that index. But what do you do if the voting or the engagement that you have with the company is not successful? And what if you engage with the company for 3 years and you don't make any success? Maybe in that case, you want to reduce the weight of that company in your portfolio, maybe even exit. But because the manager is the one who's managing the index, but not the one who's constructing the index, because that's the index provider, it's very difficult to really act on that. So this is also something to take into account, especially because with voting and engagement, here the stewardship comes in place and you have an opportunity to have impact directly on the underlying firm. Yeah, future-proof. This is also an important topic because we notice that especially in the area of sustainability, objectives and needs of investors are changing quite rapidly. What investors thought was sustainable 3 years ago is often different from what they think is sustainable now. And that's because of this changing environment. And 3 years ago, we often saw many investors working with exclusions, maybe a little bit of sustainability integration with ESG. And nowadays, carbon and reducing the carbon of a portfolio is a much more important topic. And maybe in 3 years' time, it's something else, right? Maybe it's biodiversity. So this is also something to take into account. If you take a particular index, it's often a static approach. So how to make sure that that's also future-proof. And the last one, there has been a lot of academic research, 50 years of academic research, that also shows that there are ways to create some additional return in the long run, some extra return on top of an index. And we think it's also good to take that into account. So how to solve this problem? We think actually it's important to address these concerns that are mentioned here and actually basically combine the best of these sustainability elements together with active quant approach to get the best combination in a sustainable portfolio. And how can we do that? Well, for this, we take the market index as a starting point. And what we then want to do is that we want to increase the weight of companies that score well on return characteristics as well as on sustainability characteristics. So you could say the sustainable alpha companies, the green alpha stocks. And at the same time, we also want to give a lower weight to those companies that score worse on return characteristics and also on sustainability elements. So the brown loser stocks, or so you could call them. And of course, then you get the question on what kind of characteristics to look at. You can look at a whole range of return characteristics and also at a whole range of sustainability dimensions. Well, let's first focus on the first one. Like I mentioned, there's quite some research being done that show that particular groups of stocks show higher returns in the long run than other groups of stocks with other characteristics. And what are the characteristics that are often used in these research papers? Well, on the one hand, we look at fundamental characteristics. So you can think about valuation. Companies with a higher earnings to price, book to price, dividend yields do better in the long run than the more expensive companies. But also on the quality side, we see that companies with strong quality characteristics, you can think about companies that buy back shares, in the general do better than companies that issue new shares, but also strong profitability characteristics. These companies do better than companies with the other characteristics. Well, then we also look at trend characteristics. For example, if we look at momentum, momentum, but in this case, stock momentum. So we look back at the price development of a stock in the past 9 to 12 months, and companies that did well in that period also tend to continue to do well in the next period. So this is continuation in price development. This is also an interesting predictive characteristic for the future stock price. And another one is analyst revisions. So we also know from research that if analysts revise their earnings estimate of a particular company upward, that's a positive sign. And if they revise it downward, it's a negative sign. Well, you could say these are more medium to long-term type of characteristics. At the same time, we also think it's important to look at more shorter-term characteristics based on also often more innovative data sets. I will also give you one example later on, which is related to peer group momentum. It's a short-term momentum factor that if the peers of a company do well in the recent past, this company also continues to do well in the near future. So let me now, this is more high level, let me give you 2 examples of these type of factors in more detail and also how we deal with particular challenges also related to sustainability. I want to give you an example of valuation, and I would like to give you this example of such an innovative factor, this peer group momentum. So let me start with valuation. And here also the link with sustainability immediately comes in. Because often if you select value stocks, these are typically not the companies that score very well on sustainability. Many of these value stocks are in asset-heavy sectors, are asset-heavy firms like in the energy sector and the utility sectors, and they often have high carbon emissions or other high footprint measures. We also see that on the slide, that you can see if you select these value stocks, actually the carbon emission is higher than the benchmark, but also if you look at water use or waste generation, these companies score in general worse than the benchmark, worse than an average company. The question is actually whether that has to be the case, right? Is it needed to get this high carbon emission on board when you select a value strategy? And we don't think that has to be the case. And before I show you the results of that research, I thought it's nice to give you an example of two value companies, which are actually in the same sector, in the material sector. It's a company, Alumina, that's an Australian firm, and Norsk Hydro, which is a Norwegian firm. And they both work in the area of aluminium. And as you can see, if you look at their value characteristics, they are both value firms. They have both high dividend yields. They also have both a reasonable book-to-price ratio. Still, there's quite a big difference if you look at the different sustainability characteristics of these two firms. Where one has, this Australian firm has quite high carbon emissions. It's a more traditional aluminium firm. And also a low ESG score, while actually this Norsk Hydro firm is working more with renewable energies. And also, as you can see on the output, it has a lower carbon footprint and also has a higher ESG score. So if you construct a value portfolio and you also want to have a highly sustainable component in that, then it's better to select these companies like Norsk Hydro instead of those like Alumina. Well, this is, of course, one example. And the question is, are there more of these companies, these value firms, which also score well on sustainability? And the answer is yes. So we looked at that. And we call this our decarbonized value strategy, where we select these kind of value stocks that actually have low carbon emissions. And we present them here with the green bar. And you can also see that in terms of emissions, in terms of footprint, these type of stocks actually score similar as the market. So they're not more polluting. And this is, of course, the first important step. The second step could be, what about the return of these type of companies? Because if value stocks outperform growth stocks or expensive stocks in the long run, do we also expect then these value companies with a more greener profile also to do well in the long run? So we also looked at that. What we did is that we looked at all these value companies and we split them in a group with high emissions and with low emissions. And we looked at the return over more than 30 years period. And what we can see, and that's presented in this graph here, is that if you look at the return characteristics of these firms with high and with low emissions, whether we look at greenhouse gas emissions or water use or waste generation, the returns are actually very similar. So this is a way to possibly enhance a valuation strategy in the area of sustainability, to actually select these low emission firms, these less polluting value stocks, and actually you can create a similar type of returns in the long run, but of course with a more sustainable profile. So then let me also move to another example in terms of return, this more short-term innovation signal, peer group momentum. So the idea here, like I mentioned, is that if the peers of a particular company do well, then this company also tends to do well in the near future. And then the question is, of course, how to define peers. And often peers are defined as companies in the same sector or the same subsector. But we actually find that this is not always the most optimal way to define peers, especially not in terms of predicting future stock returns. And let me show you this with the help of this very nice graph where we see Apple in the middle. And Apple, we know that's an IT firm. Its official sector classification, or industry group, is hardware, IT hardware. So it's basically in the same subsector as Cisco and Motorola. But of course, we know it has also strong connections with other type of firms, not only in the IT sector, but also in other sectors, like the consumer discretionary sector. Think about companies like Best Buy and Amazon, but also in, for example, the communication services sectors. It's also peers like Facebook or Alphabet, Netflix, these kind of companies. Actually, it's even also related to companies in the automobile sector, like Tesla, right? It also has a connection with that. So the question is, how do we find these peers? How have we come to this peer group analysis? Well, what we've done is that we look at the analysts that are following Apple, and also what kind of companies these analysts are also following. Because often analysts, they follow companies that are quite similar. And we notice that the analysts that follow Apple, they also follow these other companies that are connected to Apple. And of course, these other companies are then again connected, right? So this is a typical example of big data, because for every company, you have to investigate these connections via the analysts. And also, this is not static, right? This can also change through time. So also, if you do historical analysis, you have to keep on track of these analyst connection. And we find that if the peers of Apple, if they recently did well, then Apple also tends to do well in the near future. And of course, this holds for if we look at a large data set of many companies. So these are some examples of how to look at return characteristics and take that into account when building a sustainable alpha with the objective of also delivering higher return. And let me also discuss the sustainability characteristics. Of course, there are many dimensions to look at, and we also notice that investors have different preferences here. We see that investors work with exclusion lists. Of course, active ownership, stewardship is very important, the voting and engagement. The carbon footprint, we see coming back, but also the integration of sustainability scores. The preference is to have a higher ESG score, for example, than the index. Other footprint measures, we talked about that, water and waste, and also, for example, sustainable development goals. So this is the multidimensional approach that can be taken into account. Now, the challenge, of course, is that if we build a sustainable portfolio, we are aiming to actually look for those companies that both score well on different sustainability dimensions, as well as score well on these return characteristics. So we're actually looking for the sweet spot here. So that's also what we do. So that's our intention. Our intention is to select those type of stocks. And besides the sustainability characteristics, I will later on give an example portfolio as well. Besides looking at the sustainability characteristics, I already mentioned also a bit on voting and engagement, this ownership. And I think it's good to touch upon that in a bit more detail, because we did quite an extensive study to how actually is being voted by managers. You can actually, of course, there are many things you can vote on if you are an investor in a firm, but there are also typically E, S, and G related topics that you can vote on. And we looked at how managers actually voted on these type of topics. And what we thought was very interesting is we were actually surprised how often it's voted against these kind of sustainability proposals. Actually, in more than 50% of the cases, managers vote against these type of sustainability proposals. And if you look at this graph, you can actually see that that has increased through time. So it has improved in that sense. There's more often managers vote in favor of these sustainability proposals. But in the past, like 10 years ago, this number that was voted in favor of was actually really low. You also see differences in terms of managers. We notice in this research that especially the larger managers and the passive managers, they vote more often against, although you do see that there's also an upward trend here. Well, in the US, why we looked at US managers, it's good to mention maybe, is because in the US, managers are obliged to report their voting records to the SEC. So that data set is actually available. That's not the case in Europe. But if you would be interested in more general how a manager votes on sustainability topics, I'd like to refer to a very nice ranking list made by Share Action. They also look at particular climate proposals and ESG proposals and how managers vote on that. And you can actually see how managers are being ranked on that. And you will also notice that typically, on average, European managers score also better on that than US managers. And I think this is in line with the developments that we've also seen that in Europe, sustainability has even a bigger role in the investment process than in the US. Then I also mentioned about this future-proof in the beginning and how to make sure that a portfolio can be future-proof. Well, we notice that investors have these different demands, especially in the area of sustainability. But it's also for a particular investor, we notice that these demands can change through time. And that's why we built special tooling. We call it our Quant Customizer. Might be a bit nerdy. Maybe we have to think about a more special name here. But this is actually a tooling that we use to construct a portfolio on the spot. And you can also use this as a kind of regular checkup of your portfolio. Like you can do it, use it once per year, once per 3 years, to see if you think your portfolio is still up to date. And this is a screenshot actually of part of that tooling. And I thought it's nice to show you a particular portfolio and also show you the characteristics of that portfolio, namely of the Momentum Global Sustainable Equity Fund. And this portfolio looks very much similar to that. So first of all, you see the selection here of the index, the MSCI World Index as the benchmark. And then the objective can be selected. So in this case, the objective is to both generate better sustainability characteristics as well as stronger return dimensions. Well, the risk budget is also something that can be selected. So the relative risk, in this case, we select enhanced indexing kind of strategy with a tracking error of around 1%, a little bit higher, to select those companies and give a bit more weight to those companies that score well on both the sustainability as well as alpha components. Well, then in terms of sustainability, there's also a lot to choose. You can change a whole range of exclusions, which are also applied here. I won't go into detail now. The ESG profile, you can say, well, this portfolio has a 20% better score than the underlying benchmark. And also in terms of environmental footprint, this portfolio we selected now has a 20% better carbon reduction and also 20% better water use and waste generation. Well, it's also interesting to look at how the characteristics of this portfolio look like, both in terms of return as well as in terms of sustainability. Well, then we can have a look again at these return characteristics. And what we see is that of this particular portfolio, if we look at value, quality, momentum, analyst revisions, we see that this portfolio scores indeed better than the underlying benchmark, because that's of course also the way how we constructed that portfolio. And also if we look at sustainability, we can also see if we look at the ESG score, or we look at these emissions, water use, waste generation, we also see that this portfolio scores better than the benchmark. Well, this is, of course, you could take a picture, but you can, of course, also have a look at it through time, more like a film, if you want to do historical analysis on that. Okay, then I thought it's also nice to give you some examples of stocks that are actually attractive in such a portfolio. So what are these stocks that score well on both sustainability as well as these return characteristics, to make it a bit more tangible, all that quant information. And we present 3 types of companies here that actually are attractive on both of these dimensions. We have Hydro One, which is a Canadian company based in the energy sector. We have Synopsys, and this is an American IT company. And maybe you know Pearson, it's based here in London, UK firm, focusing on education, also does a lot with online education. And actually all 3 firms, they score quite well on these characteristics, right? They have strong value characteristics, strong momentum. Pearson, for example, scores very well on momentum, analyst revision, strong trends there. And also they score well on these sustainability characteristics. And these are more like medium to, I would say medium-sized firms that we think are attractive candidates for in our portfolio. Okay. So then it's good to also wrap up, maybe thinking back about those concerns that I presented in the beginning of a purely sustainable passive approach. One of these concerns was related to the lack actually of using academic insights to create better than benchmark returns. And it's good to take that into account by looking at these proven factors like value, quality, momentum, but also to take more innovative shorter-term signals into account. Now, we also had concerns related to the use of one sustainability dimension, often in these indices, and that is good to take at multiple dimensions to take that into account. And also we talked about this voting and engagement. That is also good to reflect that in the positions, right? So if your engagement is not successful, you can actually also decide to lower that weight of those companies in portfolio or even exit it. And if you combine all that, well, then you get basically the best of both worlds combined in, also in this strategy here. And what's also good to mention is that for the future proofness, good to regularly do a checkup of the portfolio to see if it's still in line with the recent developments also in the area of sustainability.